Hello, and welcome back. So today, what we will be doing is that we'll be doing this particular question called MMC. Okay, so what is this thing about? So Mesmer's Magico, or let's just refer it to as MMC. Okay, so whatever that is, it's just a name of a company, right? So what is happening? What's happening is considering whether to undertake a development of new computer-based game on an adventure film which is due to release in 22 months. In 22 months, it's developing a new computer game. Okay, so it's in a gaming kind of business, right? So it's developing games and all. So it is expected that the game will be available to buy 2 months after the free film's release. So that means it will be what, 22 months plus 2 will be 24 months. So after 2 years, right, it will be available to buy. Okay, so maybe it's no, it's available online, maybe. I'm not sure. So by which time will it be possible to judge the popularity of the film with a high degree of certainty? So by that time, it'll be possible to judge the popularity of a film with a high degree of certainty. Right now it's very uncertain, right? However, at present there is considerable uncertainty about the whether the film and then the game is likely to be successful. Okay, there is a lot of uncertainty. So although MMC, let's just see this thing, yeah, in the beginning. What, I did not see this requirement. Let's just read that as well quickly. Sorry about that. Estimate the financial impact of director's decision to delay the production and marketing of the game. So it's a BSOP model. Okay, so the BSOP model may be used. Okay, they've specifically told us, and then all relevant calculations should be shown where appropriate. Okay, so model should be used where appropriate. So the decision to delay the production and marketing of the game. Okay, 13 marks. Briefly discuss the implications of the part answer obtained in part A above. So implications. Briefly discuss the implications. 6 marks. MMC is funded partly by equity and partly by debt. The yield on its 5-year debt is 5.2%, and then the yield on its 10-year debt is 5.4%. Okay. MMC faces an upward sloping yield curve. Okay. So what is the reason for an upward sloping yield curve? Okay. We have 6 marks for it. So it's a 25 marks question, right? So not a big thing. However, at present there is a considerable uncertainty about whether the film and then the game is likely to be successful, right? Although MMC would pay for exclusive rights to develop and sell the game now, would pay it right now, the directors are of opinion that they should delay the decision to produce and market the game until the film has been released and then the game is available for sale, right? So they are of a decision to should delay. So it's an option to delay, right? Option to delay. MMC has forecasted the following end of year cash flow for the 4-year sales period of the game, right? Okay, remember, this is not year 1, this is 3rd year, this is 4th year from now. That's why I'm saying that from now. 5, 6, right? So what will happen? MMC will spend 12 million to develop the game, the gaming platform, and to pay for the exclusive right to develop the game. Following this, the company will require 35 million for production. Following this, right, for production and development and marketing activities at the start of the 4-year sales period of the game. Okay, so they will need that as well. So it will be how much? 12 plus 35, that will be what? 47 it will require, right? PA, right? E, I think, because you will need the present value of it, right? So it is assumed that the all cost and revenues include inflation. Okay, so these includes inflation. The relevant cost of the capital project is 11%, and then risk-free rate is 5%. Okay, for capital project is this much. MMC is estimated the likely volatility of the cash flows at a standard deviation of 50%. Okay, so these cash flows have not been discounted. We need to discount it first, right? You see, I just see only cash flow, right? So let's discount it using 11%, right? After that, what do? We get the PA value of it. We just add all this thing up after discounting, and then we get the value, and then we just use the PISUP formula. Okay, so let's go. Let's go to this. Let's go to the solution. A number, right? So what was the cost? Initial cost to develop the game is 12 million, right? So 12 million will be incurred whether the option to delay is exercised or not. You see the point over here. It will be spent anyway, anyhow, right? So since it is common to both scenarios, it can be ignored in the calculation for the moment. Okay, so we are just ignoring it. And what is happening over here? The net present value of the project was undertaken immediately without the option to delay. What would happen? In that circumstance, we would have a cash outflow of 35 million only, right? 35 million, and then we have all this cash flows, and then we discount it, right? And then our total NPV is 12.73. Or we can say, or we can say if we subtract the other thing as well, the 12 million as well, it's just 0.73, right? 0.73 if we take into account of the 12 million initial investment, right? But if the project were to be delayed for 2 years, right? If it were to be delayed, right? If it were to be delayed for 2 years, what would happen? What would happen is that without an option, it's this much, or we are just getting 0.73 only, right? Right. We are just getting 0.73 in the if we use the option, or if there was a option, what would happen? Basically all these values would be 3 4 5 years, right? And then we are using 11% at 3 years, 11% at 3 years, and then we discount it, we get this value, right? And then what would be the present value of it? Present value of it would be this much. So this becomes our PA, right? In the option pricing model, right? So it's always PA is what? Present value of cash inflows, right? So the present value of the cash inflows could alternatively be found by simply applying a 2-year discount rate at 11% to the existing figure. 2-year discount rate 0.8212. Yeah, we could just do that. Basically what we could do is this amount, because you see this amount is like the total value of it, right? All the cash flows from here to 4, but this figure, this whole thing is we could just discount it using the 2-year discount rate. Okay, we could do that as well for the 2 year to delay, because you see this figure is only happening, or it's going to happen after 2 years, right? So rather we are just estimating it to be, in this case we assumed it's going to happen today, right? From today, but in this case what has happened, we were going to exercise it after 2 years, right? So that's why we discounted back 47 million, right? That's why we discounted back. Okay, so if you don't understand this, please do comment down below, I'll definitely help you out. Okay, so what's the variable? So in the first case we are going to exercise the option, right? So what's the variable? So it's going to be present value of the cash inflows, right? So 38.75, right? Present value. PE is what? 35 million, right? Exercise price. So 12 million was ignored because it will be incurred anyway. Why did we ignore it? It can be ignored for the calculation in the moment, right? For the moment, right? It is common to both scenario as well, and then that's why. Let's just say that. And then we just get the exercise date is 2 years, risk-free rate is 5%, the volatility rate is 50%, and then we use the formula, right? Always remember how to calculate the formula, right? And then after that we just compute the formula, we get this figure. This number is greater than 0.5, so what do we do? So we just add in this number, so that is 0.64, right? So what do you do? 0.64, that means you look in the table from 0.6, and then you look in the 0.04 section. Okay, so whatever the value is, you bring in that value, and if it is greater than, it's greater than 0, right? So we just add in the 0. Okay, because you see in your distribution it's 0, right? in the normal distribution table. So what has happened, you are going, since this value is what, greater than 0, so it has to lie over here, right, not less than 0. So that's why this figure is, this value is how much, this is 0.5, right? So we need to go across. So if you want to go this side, what do, you add it up. Okay, so this is minus this is 0. This is less than 0.5, right? So if the number would have been less than 0.5, what do, you would do 0.5 minus this thing, because you would have to go from here to somewhere, whatever the minus figure is. That's why. Okay, if you don't understand, do let me know. I'll definitely help you out with that as well, right? And then after that, what do? We get the value of the option to delay, right? So option to delay, so we just get the D1 and then D2, and then after that we just plug in the values, and then we get 13.68 positive value, right? 13.68. What was the value over here? In this case it was 12.73. so 12.73, we get 13.68, right? Discuss the implications of the answers obtained in part A above, right? Part A above. I think we can just move this thing to the side for now and then just read through it. So the option to delay the decision has given MMC manager, the option to delay has given the MMC manager the opportunity to monitor and respond to changing circumstances before committing. Okay, it's given us the flexibility, right? Such as the rise in popularity of this type of game or this type of genres of film in next 2 years, or increased competition from similar new launches, or a sustained marketing campaign launched by the film producers before its launch, right? So they could just watch out for that thing. Like, let's say if the film producers are like like spending a lot of money in marketing and all, and then the film has picked up, right? So it has a different type of audience with it, then launching the game will also be very meaningful, right? It'll be very financially viable as well, right? So it gives us this flexibility, right? So that's why, that's what they are basically talking about, right? In your exam as well, you should talk about that. So without taking account of the option to delay, the project has an NPV of what, 12.73, which reduces to 0.73 after taking into account of the 12. So it's just 12.73 minus 12. Okay, 0.73. If we take into account of that 12 million as well, so we will have a very marginal value, right? A marginal return on it. So marginal positive NPV. So it's quite small positive figure. So the project is very sensitive to changes in cash flow. So if there is any changes in cash flow, it will have an impact on it, right? It will even the value could be negative. The value could be negative, right? And even the value could be negative. Okay, it could be negative. So always sensitivity analysis in such circumstances is always best, right? It's always best. So by taking account of the option to delay, the value of the project increases to 13.68, right? After taking into account of the 112 million, 13.68 minus 12 will be 1.68, right? 1.68 million. Right. So this shows that the existence of the options to delay makes the project more attractive, right? So it's 0.73 and then 1.68 makes a lot of difference, right? So unfortunately, the option pricing model requires numerous assumptions to be made, and then the primary one being the assumptions of volatility. So therefore does not provide a correct value, but an indication of value of the option to delay the decision. Hence, it indicates that management should consider the project further and not to dismiss it, even though current conventional NPV is quite small, right? What has happened? So NPV plus the option will give us the strategic NPV, right? So we call this strategic NPV, okay? This will give us the strategic NPV. The option to delay the decision may not be only option within the project, but for example, the option to delay the decision may not be the only option within the project. For example, the gaming platform that the company needs to develop this game may have general programs which may be used in future projects, right? So what could happen is that you can have a follow-up project, okay? Or you could have an option to redeploy, right? Option to redeploy. Option to redeploy the existing infrastructure, right? So what do we have? Option to delay, option to follow up, right, or deploy. Let's just say that, and then we have option to redeploy, option to abandon, right? 4 options are there, right? So these things are put option, these things are call option, right? So you have the right to exercise it. So MMC should take account of these. So the option to redeploy, or if the film is successful, it may lead to a follow-on projects, which is film sequels and all as well, right? So the game will be even more popular. They can have a second part of the game as well, which could include all these characters and all. It could, like you see, like the Marvel franchise, it keeps on going on, right? So the company is facing a upward upward sloping yield, right? The yield curve is upward sloping, right? Why could that happen? Why does it normally happen? Why does it happen? So there could be a future expectation. It's sloping upward, right? It's sloping upward. So if the future short-term interest rates are expected to increase, then the yield curve will be sloping upward, because they will be they are expecting to get a higher return in short term, right? In the short term, they are expecting to get a higher return. The greater the expected future rise in interest rate, the steeper the upward slope of the yield curve will be, because there is a relationship between them, right? So what has happened, basically the people will be getting more return on more interest rates, so that's why they won't be willing to invest, right? So liquidity preference, right? It could be another reason, could be liquidity preference. So it could be like where there is high uncertainty in the economy and all, right? So it's argued that investors seek extra return for giving up a degree of liquidity with a longer term investments, right? If you're making a long term investments, what has happened, basically in the long term investment, you will need to provide extra return, right? Extra return. What will happen? You will need to provide extra return, right? And then what else? Other things be equal, the longer the maturity of the investment, the higher the required return, right? Because it'll be more risks to the investor. That's why you see they're talking about risks. So 3 factors they are talking about: increase future expectations and liquidity preference. The future expectation could be based on interest rate, right? So if the higher the expected rate of return, higher the slope of the yield curve, right? Upward slope of the yield curve. Liquidity preference, so if there is uncertainty in the economy and all, people want to keep their money with them, right? So it's rather than making an investment in a risky environment, right? So if during this COVID and all as well, people didn't invest much, right? So I'm not talking about exact figures, but normally you would not be wanting to invest in such circumstances, right? You will need some money as a cautious money, like it's like a rainy day kind of money, like sick day kind of money kind of thing, right? So you'd want to hold on to it more, right? Otherwise what would happen, you would have to be enticed by a higher return, then only you'll be greedy, and then only you'll make some investments, right? So that's what happens. And then even like you, rather than committing to a shorter period of time, people want to commit for only a short period of time, because in long period of time what happens, basically there will be higher uncertainty, and then people want you see, like they'll be thinking like the money will be held up for a long period of time, right? Another thing is preferred habitat or market segmentation, right? Market segmentation. So different investors are more active in different segments of the yield curve, right? So there is a lot of investors out there, and then many want to join the wagon in like different time period and all as well, and then or different when there is a different kind of movement, right? So for example, bank would tend to focus on short term end of the curve, right? While pension funds are more concerned about medium term and long term, right? So they want a steady return, right? An upward sloping curve could be in part the result of fall in demand of the longer term yield, long term segment of the yield curve, leading to a lower bond prices and higher yields. Okay, this could be the reason as well. So it could be a fall in demand for long term segment of the yield curve, leading to a lower bond prices and higher yield. Okay, so there could be a different kind of investors whose choice is not the same. Okay, so banks, if it is a bank, so they would basically be around like short term end of the curve kind of thing, right? So they would not join it immediately. I mean, they would look for short term returns, whereas pension funds and all, they would want a higher return on it, right? So yeah, that's pretty much it. I'll see you in the next video. Do like, share and subscribe. That's it for this video. Take care. Bye bye.